If you're building wealth, the real question isn't just how much you can grow your pile of money, it's how you get to keep it in the family. Things like taxes, fees, and probate can all play a part in your estate plan. Without a smart estate plan, a huge chunk of your hard earned legacy will disappear. But the good news, with the right strategies, you can legally and efficiently pass on more wealth and pay far less in taxes. Today, I'm walking you through the exact tools you can use just to do that. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make the most of their money. Let's jump into the video. Most people don't realize this, but the US tax code actually gives you a lot of opportunities to transfer wealth efficiently. As of 2025, each person has a lifetime exemption of $13.99 million. Plus, you can gift $19,000 per person per year without using any of that exemption at all. That means if you start gifting early and consistently, you can move hundreds of thousands of dollars out of your taxable estate and will never be touched by the estate tax code. And if you're married, you can double that number to $38,000 annually from a gifting standpoint, or just under $28 million as a lifetime exemption standpoint when you have the marital unit counted as one person. So gifting isn't just about giving checks to kids either. You could do things like paying for their college costs directly to the institution which they're attending, or paying for medical costs for somebody and paying the hospital system directly for those costs. Doing it in that manner also won't dip into your lifetime exemption. It's really important to understand this because without a plan, large estates can incur a 40% federal estate tax fee. So proactive strategies like this are crucial. Now, a question that I often get is, should you gift assets now or hold on to them and then pass them on as part of your estate plan to a beneficiary? And here's the trade-off. When you gift assets during your lifetime, more often than not, the donee or the person receiving your gift is going to keep your original basis. The donee in this instance, and they sell an asset later, they could owe big capital gains taxes on that. But if you hold the asset until death, your heirs or your child in this instance would get a step up in cost basis, meaning the value will reset to the fair market value on the day you pass away. They could sell the asset immediately with little to no capital gains tax implications in this scenario. Now, there is one caveat that I do want to talk through, and we're going to do an example of this in a minute, and that's gifting property that's in a loss status at the time of the gift. So let's walk through an example because I just want to help you think through some of the other nuance to gifting versus an inheriting strategy when it comes to your estate plan. Okay, so let's walk through a brief example here when you're trying to gift a certain security to someone else. And we're going to talk about it specifically when you're gifting a security that you purchased for more than what it's currently worth. So it's currently in an unrealized loss status. So let's say you bought XYZ stock for $10,000 and you want to gift XYZ stock now to someone else for $5,000. So there's a couple of different scenarios that we need to walk through in order to understand what are the tax implications for gifting this piece of property in a loss position, specifically when the person we're gifting it to or the donee goes to sell it on later. So let's say in the first scenario that this individual sold XYZ stock for $13,000 after you gifted it to them. So their basis in this instance would be the greater of the $5,000 or the $10,000. So their basis here is $10K. And that means their gain is $3,000. And it's easy to follow this. So it'd be the same exact as if you would have held the security in your name as it is when they sell it for $13,000. So you bought the security for $10,000. If you were to go and sell this, it would be worth $13,000. And when you sell it, you would incur a $3,000 gain. So this scenario would work exactly as if you sold the security yourself. Let's chat a little bit though about if this person were to go and sell the stock for $3,000. So their basis in this instance is going to be the lesser of the fair market value when they received the gift or what it was when you purchased it. So we know that because you're gifting to them in loss status, the fair market value of when they received the gift will always be lower. So their basis is going to be $5,000. And that means their loss that they get to record is only $2,000. Now, think about this. If you would have just held that security outright, you bought it for $10,000 and now you sold it for $3,000, you would have incurred a $7,000 loss, or you'd have been able to realize a $7,000 loss. Whereas the person who received the gift from you, they only received a $2,000 loss. And it's because it's actually punitive to receive a stock as a gift when it's in a loss position. So there's $5,000 worth of loss, which you were unable to recoup from your original investment. So this would be disadvantageous in this scenario. So the third scenario is, what if the security for in between the 5,000 we received it as a gift and the $10,000 that you paid for it when you originally bought the security. So your basis will always equal the dollar amount in which the sell happened. So if you're between that 5,000 and $10,000 here, your basis is going to be the $8,000 you received that is currently worth, and your gain or loss is going to be $0. So in this instance, it's still punitive because if you would have just taken the stock and sold it yourself and not gifted this, you would have been able to realize a $2,000 loss. So it's just something to consider when you're looking at gifting assets. It's not always as straightforward as what you paid for versus the person you gifted it to is selling it for. There's some other nuance that you need to be aware of, and this is often somewhere that I see a lot of clients get tripped up on, especially if they're thinking they can book losses for somebody who might have more advantages for booking higher losses than themselves. So just something to consider when you're looking at a gifting strategy for stocks. So if you're gifting cash or assets that haven't appreciated all that much, lifetime gifting would make a lot of sense in that scenario. But if you're sitting on something that's massively appreciated like stocks or real estate, it might be better to hold off and let your heirs receive the step up in cost basis. This decision needs to be strategic and based on the type of asset, your financial goals, and your overall estate planning strategy. Now let's talk a little bit about trusts. And trusts are a major tool for efficient wealth transfer. A revocable trust won't save you a ton of money on taxes, but it does help you avoid probate and keep your affairs private. It also ensures that if you become incapacitated, your trustee can manage your assets without needing court approval. Now, an irrevocable trust, on the other hand, removes assets from your estate completely, and this is where a lot of the tax savings from an estate tax standpoint will happen. You can set up something like a grantor retained annuity trust to pass appreciation of assets with little or no gift tax implications. You can also create dynasty trusts that help pass wealth across multiple generations without paying estate taxes or capital gains. Trusts can protect assets from creditors, ensure responsible management by future generations, and even provide incentives for beneficiaries to meet certain milestones. When I run projections for clients, I often recommend they set up a revocable trust for simplicity. It's an easy way to avoid probate, protect assets, and ensure your money goes to where you want it to go when you're ultimately no longer here. But when I run these projections and clients are trending toward having a taxable estate, it's imperative that we start thinking about utilizing an irrevocable trust to remove assets from that estate. Creating a strategy with your financial planner and your attorney is a great first step in structuring your irrevocable trust appropriately. And the idea here is to use current gifting strategies up to the annual limit to reduce your estate tax today and invest those monies for your beneficiaries tomorrow. Now, for bigger estates, family limited partnerships and LLCs can make a huge difference. You can move real estate, businesses, or investment accounts into an entity and give shares of that entity to your heirs. Because those shares come with restrictions, like lack of control and lack of marketability, you can apply valuation discounts, sometimes in the neighborhood of 20 to 40%. That means that you can gift more value while using up less of your lifetime exemption. Plus, you can keep control of the assets while gradually transferring ownership to the next generation. It's a smart way to transfer both wealth and responsibility. These structures also provide asset protection benefits, shielding family wealth from lawsuits and creditors. Now, when it comes to this type of arrangement, it's very important to consult with a licensed attorney when structuring these types of vehicles. They can walk you through the nuance of this type of setup for your state tax picture from both the federal level and the state level for which you live. Often what I find is people maximize for the federal level and they completely throw out the state level, and these limited partnerships or these LLCs that they've structured to pass on to the next generation aren't done in compliance with state laws. So you just want to make sure you're compliant from both a federal perspective and the state perspective. Charitable giving can also be a big part of an efficient wealth transfer strategy. If you're already planning to give money to charity, structuring in the right way can save you tens of thousands, if not hundreds of thousands of dollars in taxes. You can donate highly appreciated assets directly to a charity and avoid paying capital gains tax. You can set up something like a charitable remainder trust to get current income tax deductions and provide an income stream for life, with the remainder going to a charity. Or you can leave a portion of your estate to charity in your will or trust, and that will reduce your taxable estate dollar for dollar. Charitable remainder trusts operate very similarly to annuities or pensions. You promise a charity some amount of money once you pass, but each year you're allowed to take a certain percentage of those assets as income. So let's say, for example, you want to leave a charity $1 million and you utilize a charitable remainder trust. You might be allowed to take out 5% of that gift amount each year for some specified amount of time or for the rest of your life. This is typically determined by inception, and there's some mandated rules that you have to follow to determine your income percentage, but we're just going to use 5% as an example here. So in this instance, you would receive $50,000 per year in income, and the hope would be that the corpus, or what's left of the $1 million that you put in after your distributions, grows by an amount greater than that each year. So you're passing on to that charity at least $1 million, if not more, when you ultimately pass. Now, something else that I've seen some clients use are charitable lead trusts, and it's just the exact opposite strategy of what we just talked about. In these trusts, you give an income stream to a charity now, and your heirs will receive what's left over later on. So, in that same instance where you have $1 million and there's a 5% rate that you can pull money off of the corpus of the funds, you would send the charity $50,000 a year for the rest of your life or for some specified period of time. And then your beneficiaries will get what's left over when you pass. Ultimately, it ends up the math ends up the exact same way. It's just the order in which the charity is receiving the money. So if it's more important for you to give some income to a charity now, you'd want to use a charitable lead trust. If it's more important for you to give them a big lump sum later on, you would want to avoid using that charitable lead trust. Now, another creative strategy that I've seen used is using intra-family loans. Instead of gifting money outright, you loan it to your family members at the minimum IRS approved interest rate. This is called the applicable federal rate, and it's often lower than what you'd be able to get on the marketplace at a bank or a peer to peer lending site. If they invest the money and earn a higher rate of return than the interest they owe you, all of that excess growth transfers to them without triggering gift tax. There might be some capital gains tax or ordinary income tax implications on the interest earned end, but from the estate tax standpoint, this is all thrown out of your estate. This can be a huge win if you're helping a child with buying a house, starting a business, or just investing in general. These loans need to be properly documented with promissory notes and payment schedules to be respected by the IRS. If structured correctly, they are a flexible, tax efficient way to support your family's financial growth. You'll also want to make sure you're accounting for imputed interest if you're lending at a rate below the applicable federal rate. So let's walk through a brief example of what I mean about when it comes to imputed interest. All right, so let's assume that you want to loan a family member $100,000 at a 3% rate. So in this instance, we know that you would have received $3,000 in interest for the year. And that means that's income that you have to record on your tax return. But the second thing that we have to compare that to is what's the applicable federal rate. Let's say that the applicable federal rate is a little bit higher. Let's say that's 4%. So we know that you should have realized $4,000 worth of interest, which equals income for the year. So because you lended at a rate that was lower than the applicable federal rate and collected less money, you would think that you would have to realize the lesser amount as income for the year. But because you were below the applicable federal rate, the amount that you have to realize for income on your tax return is the $4,000, even though you want to receive $3,000. That's why it's so important to be aware of imputed interest when you are doing intra-family loans. If you want to help with education, 529 plans can be a fantastic tool. And this is one of my favorite strategies. Contributions to 529 plans grow tax-free and can be withdrawn tax-free as long as the funds are used for a qualified education expense. You can also supercharge 529 plans by front-loading 5 years worth of annual exclusions all into a one-time lump sum investment. In 2025, you can contribute $95,000 at once per child or grandchild and pull that money out of your estate immediately. For married couples, this is $190,000. Plus, you retain control over the account and can change beneficiaries if needed. This strategy not only funds education, but removes a significant amount of your assets from your estate. 529 plans have become even more flexible recently, with provisions allowing unused funds to be rolled into a Roth IRA under certain conditions. This adds even more versatility to this powerful planning tool. And even after all of that, the original beneficiary does not use all of the funds and you can then assign those funds to someone else within the family. And because 529s are considered a completed gift, they are not included in your estate when you pass. However, it is important to note that if you did choose the super funding or the 5 years worth of contributions in 1 year, if you were to pass away within that 5-year window, a prorated portion of that gift will be added back to your taxable estate as long as you don't meet that 5 years or more, the 5-year or more window past when you put the original contribution. Life insurance is another strategy to consider. Life insurance proceeds are generally income tax-free to your heirs, but if you own the policy yourself, the death benefit will be included in your taxable estate. That's why many people use an irrevocable life insurance trust or an ILIT. With an ILIT, the trust owns the policy, not you. So the death benefit stays out of your estate and passes to your heirs completely free of income and estate tax. Life insurance can create liquidity to help pay estate taxes, equalize inheritances among children, or simply provide a guaranteed legacy. It's a flexible and reliable tool, especially when paired with other estate planning strategies. If you're late to the estate planning game and you think you're going to have a taxable estate, specifically if you're over the age of 55, the leverage you can receive from a cash value life insurance policy may be able to provide you with a greater bang for your buck than investing inside of a trust directly into the stock market. I find this is often not the case for younger investors, but it is a strategy that should be talked about, especially if you want to ensure that your estate taxes are not going to be overly burdensome to your beneficiaries. Real estate and closely held businesses requires special planning. With real estate, you have the advantage of a step up in basis at death, but you might want to consider other strategies like a qualified personal residence trust to transfer homes at a discounted gift value. For businesses, tools like GRATs, sales to intentionally defective grantor trusts, and Section 6166 deferrals can help you transfer business interests efficiently and avoid forced sales to pay estate taxes. Succession planning is critical to maintaining the value and continuity of family businesses. It's important to start something now, many years before you pass, to avoid paying unnecessary taxes. When it comes to passing wealth efficiently, it's about using the right tools at the right time. Lifetime gifts, trusts, family entities, charitable giving, strategic loans, education planning, and life insurance all work together to maximize what you can leave behind. You want a coordinated plan that fits your assets, your family's needs, and your legacy goals. And it's critical to review this plan annually because laws will change and your personal circumstances will evolve. If you found this video particularly helpful, make sure to hit that like button and subscribe to the channel so you don't miss any future updates. And if you're looking for help putting together your own personalized wealth transfer plan, reach out to my team. This is what we do, and we're always happy to help you craft a strategy that works for you and your family. Thank you so much for watching, and I can't wait to see you in the next video.